2,240 pounds. That's the exact gap between the new full state pension and the tax-free personal allowance right now. And if you have even a small private pension, a part-time job, or a few thousand in ordinary savings, that gap has probably already closed on you without you noticing. You are not imagining it. Something has genuinely shifted in how this country taxes pensioners, and it happened fast. 11 days ago, Andy Burnham walked into Downing Street, and within days, the tax conversation for anyone over pension age changed direction. Stay to the fourth point, because that's the one that's already quietly pulling 600,000 pensioners into paying income tax this year alone, with almost none of them getting so much as a letter of warning first. I'm Michael Turner. I spent 18 years working inside HMRC on compliance and self-assessment before I moved into independent tax advice for retirees. And I can tell you plainly, HMRC does not ring you up to explain a change that benefits you. And it certainly doesn't ring you up to warn you before a change costs you money. The system runs on what you know to ask for, not on what you're quietly owed or quietly losing. So let's go through exactly what's changed, who it hits, and what you do about each one, starting with the one that's making headlines this week. The first is the mansion tax, officially the High Value Council tax surcharge, and it's already law set to begin in April 2028 on homes worth over £2 million, with an annual bill between £2,500 and £7,500 depending on value. If you've never thought of your house as a mansion, you might assume this is someone else's problem. Here's why it might not be. Reporting this month suggests Burnham is actively weighing whether to drag that threshold down from 2 million to 1.5 million, and independent tax analysts have modeled what that would mean. Roughly 150,000 additional homes pulled into scope, nearly doubling the number of families affected, many of them concentrated in the southeast, Surrey, Kent, and the outer edges of London. These aren't mansions in the way the name suggests. They're ordinary family homes bought decades ago for a fraction of what they're worth today, owned by people who never moved and just watched the market rise around them. Nothing is confirmed yet, but if your home has been valued anywhere near that range in the last couple of years, this is worth getting ahead of now rather than finding out by letter in 2028. The practical step is simple. Get an honest, current valuation of your property. And if you're anywhere close to that band, start a conversation with an accountant or solicitor now about what your options are. Because by the time legislation lands, your room to plan will be much smaller. But what happens if property isn't your situation at all? If what you're sitting on instead is an investment, a second home, or shares you've been meaning to sell? That's next, and it might matter even more to you. Capital gains tax hasn't moved since October 2024, when rates were set at 18% for basic rate taxpayers and 24% for higher rate taxpayers on residential property. But Burnham has said for years, long before he became prime minister, that Britain leans too hard on taxing wages and not hard enough on taxing wealth and assets. Tax advisory firms are now flagging capital gains as one of the most likely targets precisely because it sat outside Labour's original manifesto promises on tax. The scenario advisors are watching closely is an alignment of capital gains rates with income tax rates. Right now, a higher rate taxpayer pays 24% on the sale of a second property. Their income tax rate on the same amount of money would be 40%. If those two numbers converge, the tax on selling a rental flat or a family holiday home could very nearly double for some people. Nothing has been announced, but behavioral change is already visible. Advisors are reporting a real uptick in people quietly moving up the timeline on planned sales just in case. If you own a second property or a meaningful shareholding you were already planning to sell in the next year or two, this is a conversation to have with a tax advisor now, while the rules are still the rules you know. Almost everyone assumes the next one doesn't touch them because it sounds like a business story, not a pensioner story. It does touch you, and here's how. Burnham has signaled support for reforming business rates, the property tax that high street shops and pubs pay alongside a proposed digital sales levy aimed at large online retailers who currently pay next to nothing relative to their turnover. compared with a local shop on the high street. In the short term, absolutely nothing changes for you. But if that levy lands, retailers face a choice between swallowing the cost or passing it straight on to customers. And the categories pensioners buy most on sites like Amazon Books, health products, garden supplies, everyday household goods are exactly where a small price increase is felt hardest on a fixed income. Nothing has been legislated yet, so there's no form to fill in here. Just a habit worth building now. Don't assume the big online retailer is automatically the cheapest option. Boots, Argos, B&Q, and Tesco frequently beat Amazon on exactly these categories. And a lot of pensioners already use Amazon mainly to compare prices before buying somewhere else. If prices do start to move, that habit is what protects you. Let me tell you about Joan. Joan is 72, lives outside Guildford, and owns a small rental flat she's kept since her husband passed, worth comfortably over the CGT relevant threshold most higher rate taxpayers worry about. She'd planned to sell it at some point, no fixed date, no urgency. When she heard capital gains might align with income tax, she didn't panic, but she did finally call an advisor, something she'd been putting off for 2 years. The valuation alone told her the difference between selling this year and waiting could be worth several £1,000s either way. Joan's situation isn't dramatic. It's exactly the kind of quiet, unfinished decision that thousands of people are sitting on right now without realizing the ground underneath it might be about to shift. Now, here's the one I told you to stay for, because unlike everything else so far, this one isn't a proposal, it isn't under review, and it isn't waiting for a future budget. It is already happening right now to real people with no announcement and no warning letter first. The Office for Budget Responsibility has confirmed that 600,000 additional pensioners are paying income tax this year who weren't paying it 2 years ago. And that number is projected to reach 1 million by 2030. The mechanism is almost embarrassingly simple. The full new state pension this year sits at £12,547.60. The personal tax-free allowance is frozen at £12,570, and it stays frozen until 2031. That gap of £2,240 sounds like breathing room, but any extra income at all closes it instantly. A small workplace pension, part-time earnings, or simply the interest on an ordinary savings account. At today's savings rates of around 4 to 5%, it takes as little as £25,000 sitting in a normal account to tip you over that line. And if the state pension keeps rising under the triple lock while the allowance stays frozen, the OBR has confirmed the full state pension itself will exceed the personal allowance for the first time ever in 2027-28. Meaning some pensioners with no other income whatsoever could receive a tax bill purely for having a pension. HMRC is already sending out simple assessment letters, automatically calculated tax demands to well over 1 million people a year, arriving with no phone call first and a real payment deadline of the 31st of January. They are not scams. They will not be withdrawn. What you can actually do about it is direct, and it works today. Move savings out of ordinary accounts and into an ISA. The allowance is £20,000 per person per year, and interest inside an ISA is permanently tax-free, no matter how high rates go. And if you're married or in a civil partnership and one of you earns below the personal allowance, apply for marriage allowance through gov.uk or your personal tax account. It transfers £1,260 of unused allowance to the higher earner, worth £252 a year. And you can backdate the claim 4 years for a refund of up to £1,260 in one go from HMRC. So here's where all 4 of these actually leave you. The mansion tax is coming regardless, and the threshold might drop to catch ordinary family homes that rose in value over decades get a current valuation if you're anywhere near it. Capital gains tax hasn't moved yet, but the direction of travel points toward alignment with income tax. So anyone planning an asset sale should talk to an advisor about timing now. A digital sales levy could eventually push up prices on the things pensioners buy most online. So don't assume the big name is the cheapest. And the frozen personal allowance is already quietly pulling 600,000 more pensioners into paying tax this year, with an ISA transfer and a marriage allowance claim being the two fastest ways to push back against it starting today. If you know someone who's already retired, send them this. Today, one of these four could genuinely be costing them money they don't even know they're losing. Subscribe so the next rule change reaches you before the deadline passes, not after it's already gone. None of these four things asked your permission before they started affecting you. The least you can do is make sure you're not the one paying for staying quiet. I'm Michael Turner, and I'll see you in the next one.